Hi, good evening, everyone. Welcome to our AutoWealth Dialogues, Taper Tantrums or Not. If you are watching this for the very first time, I am Tai Zhi, the CIO of AutoWealth. Before AutoWealth, I worked for our Singapore Sovereign Wealth Fund, GIC, then a macro-driven hedge fund, and a family fund. All in all, I bring along more than 12 years of professional investment management experience. Today, I will be sharing the third quarter market performance and our AutoWealth portfolio's performance. I'm very sure everyone's excited to know how well our portfolios have performed over the years. I'll also share the fourth quarter outlook, what to expect, and the opportunities you can capitalize on to significantly enhance your investment returns. Towards the end, I'll leave at least 30 minutes for the Ask Me Anything segment. Consistent with our past webinars, we always receive overwhelming number of questions. So if you have any burning questions about market outlook, particular market developments, how to invest better, etc., you should start blasting them right away on the Q&A feature, because we will be addressing the first few Q&A first. Now, before we start, I want to quickly go through our standard disclaimer. In particular, I would like to remind everyone that the webinar and its content do not constitute an offer to sell or a recommendation of any capital products distributed by or any financial services provided by AutoWealth. If you are new to AutoWealth, please do go through our website's need-based questionnaire, where you can then assess your risk profile and receive a portfolio recommendation. Any performance and risk projections are based on robust financial modeling and past performance of the portfolio assets. While such projections are grounded on sound financial concepts and robust research, these projections are not necessarily indicative of and are no guarantee of the future and likely performance of your investments. Similarly, any references to past performance are not necessarily indicative of or a guarantee of the future or likely performance of your investments. Now let's get started with the third quarter market performance. The chart on the left shows the equity benchmark performance over the last 3 years. The MSCI USA index significantly outperformed the other regional benchmarks due to strong corporate earnings. If you are an existing AutoWealth user and have joined our exclusive Telegram community, you would already receive regular updates from me on the exceptionally strong corporate earnings and why we are very positive on equity markets this year. As a reference point, earnings of the S&P 500 companies on aggregate grew 70% year-on-year in second quarter. We are closely monitoring the third quarter earnings release, starting with the major banks announcing their earnings next week. Overall, we see the global economy reopening with higher vaccination rates, more hiring, more people getting jobs. With more people getting jobs, we are also seeing wage increases, higher disposable income, translating to higher consumption of goods and services. All this consequently drive corporate earnings growth. On the bond side, government bonds performed decent over the last 3 years, providing protection for investment portfolios during the COVID sell-off and subsequent periods of uncertainty. This year, government bonds declined due to heightened inflation concerns and expectations of an earlier lift-off in benchmark interest rates. Although I will add that those inflation expectations have now significantly moderated, and an earlier lift-off in benchmark interest rates have now been largely priced in. So, over the last 3 years, how have our AutoWealth portfolios performed? The chart on the right reflects our balanced portfolio, which is 60% in stocks, 40% in risk-free government bonds, and our long-term growth portfolio, which is 80% in stocks, 20% in risk-free government bonds. You can see on the right-hand side, the 2 bars in blue. These are the mutual fund comparisons with similar risk asset allocations. And these are funds that are available for sale in Singapore. There are about 14 of them. Our balanced portfolio, risk-free, registered 28.96% returns net of fees. And our long-term growth portfolio, risk-4, registered 34.68% returns net of fees. These outperform the average and the median of comparable mutual funds by a significantly large margin. Comparing risk-4 to the average, that's about a close to 15% difference. Similarly, you look at the chart on the left, our preservation and conservative portfolios outperform the comparable mutual funds by a significantly large margin. Moving on to the fourth quarter outlook. What opportunities can we expect? And how do we capitalize on these opportunities to enhance your investment returns? One of the key driving forces for investment returns will be the vaccination rate across the major regions. You will notice that the Western regions have reasonably high vaccination rates, which then positions them for continual economic reopening and recovery. On the other hand, many Asian economies have yet to achieve a higher than 50% vaccination rate, except for notable countries like China and of course Singapore. The vaccine inequality will likely depress Asian markets until geopolitics and supply chain constraints eventually ease off. This map shows the economic forecast on GDP growth, inflation, and employment. Economic growth is projected to be strong for full year 2021 against the backdrop of economic reopening and recovery. Unemployment is projected to remain high for full year 2021 across the regions of Europe, Asia Pacific, and emerging markets, as these economies are still in the midst of reopening. Inflation remains tame in these regions for now, and monetary policies are likely to remain accommodative. Given the US improving unemployment situation and heightened inflation, although I'll add that these are largely transitory in nature, the Federal Reserve will likely start reducing monetary accommodation at its next FOMC meeting in November. Against the backdrop of reducing monetary accommodation in the US and anticipated economic recovery and reopening for the rest of the world, the equity risk premiums currently suggest that Europe, Asia Pacific, and emerging markets will likely be the regions to drive strong investment returns in the next 12 months. That said, equity risk premium continues to suggest US will likely deliver reasonably good investment returns as well. Looking ahead at the specific market opportunities, let us zoom in again to the US, which is the largest investment market and form the single largest portfolio asset in most investment portfolios. I'll start off with this quote from the Fed Chairman Jerome Powell in his last FOMC press conference in September. Quote, "I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year." Unquote. Powell is looking for a decent September employment report, which is going to be released in a couple of hours' time, which will likely push him and the Federal Reserve to start tapering asset purchases at the next FOMC meeting in November. The complete tapering of asset purchases is significant because it will bring us one step closer to the next thing, which is the lift-off of benchmark interest rates. So let us first understand a little bit about how monetary policy, in particular benchmark interest rates, affects the equity markets. First of all, interest rate affects individuals and businesses' borrowing costs. When interest rates are low, businesses and individuals are more likely to borrow and expand or consume goods. Earnings and profitability will therefore be adversely affected if interest rates are high. Now, interest rates also affect a company's valuation through the cost of capital. So, where are interest rates today? The Federal Reserve has kept benchmark interest rates near 0% to stimulate economic recovery since the pandemic until today. Looking ahead, the Federal Reserve will likely start tapering of asset purchases at the conclusion of its next FOMC meeting on 3rd November. There's not likely to be any surprises to this because their decisions will be based on the employment report that comes out in a few hours' time. The next employment report will unfortunately come later than 3rd of November. So the report that's coming out in a few hours' time will be their last data point to make this decision. The Fed will start tapering only when economic recovery is strong and improving. This is an important fact that we ought to know. Therefore, the tapering of asset purchases shows that the market is on good solid footing. This tapering of asset purchases will likely complete in mid-2022. Half of the FOMC policymakers currently project a need to lift off benchmark interest rates in end 2022. I now like to draw your attention to the chart on the right. The chart on the right basically shows you the expectation of interest rates. Each of the FOMC policymakers' view on where interest rates should be. Now, if you look at, for example, 2021, which is the first chart on above, the solid bar and the dotted bar is actually the same. This means that the FOMC policymakers believe that interest rates should remain unchanged throughout 2021. Now, I want to draw your attention to the chart below. It shows 2022, the policymakers' projection of where interest rates should be. The solid bar shows the projections that we see in September that arise from their September FOMC meeting, and the dotted bar shows you what was their previous projections. You will notice that the change suggests that more policymakers in the latest September FOMC meeting projects that interest rates should increase in 2022 as well as the years ahead. If you notice the height of the bars, about half of the policymakers expect that interest rates will increase to the range of 0.38% and above. So this means that the FOMC is having a half-half split as to whether interest rates should increase in 2022. Equity markets have reacted calmly so far and quite positively to the September FOMC meeting announcements. We expect the market reaction to the upcoming November FOMC meeting to range anywhere from calm to slightly nervous. I will share more on how to navigate this in a while, so keep that thought for now. Next, I would like to talk about the recent market correction from 3rd September to 4th October, where global equity markets declined as much as 5.8%. So let us first understand what is a market correction and what led to the recent one. A market correction is a temporary market decline ranging from 5% to 20% from a recent peak. It is usually temporary and short-term, lasting a median of 31 days based on data from the last 2 decades. It occurs about 3 times a year on average. So what led to the recent market correction? It is sparked by the US debt ceiling in past. You can see the definition on screen. The debt ceiling basically defines the maximum amount of money that the US can borrow by issuing debt, which is government bonds. Now, this is a development that's ongoing. First of all, let us first understand, is this debt ceiling issue a new thing? The US debt ceiling has been an issue for many decades. Agreements are usually reached at the 11th hour to raise the debt ceiling, simply because US is too big to fail. No matter whether you are a policymaker from the Republicans or the Democrats, everybody knows they have to raise the debt ceiling because US is just too big to fail. Now, just yesterday, the Senate passed a bill to raise the debt ceiling to $28.9 trillion. This is projected to last the US till 3rd December 2021. The same bill now heads for a vote in the House of Representatives before the president can sign it into law. So as we get closer to 3rd December, there's a fair chance that markets may again go into panic mode. This will become a precious opportunity for everyone to capitalize on any market discount and earn extra returns. Let me first tell you outright that the news headlines will almost certainly paint a gloomy scenario. But there are 3 things intelligent investors ought to do when such a market discount presents itself. Number 1, don't panic. React to it as if it is a precious opportunity for you to earn extra returns. Commit to a regular investment top-up if you have not already done so. Regular investment top-ups helps you to overcome your inner fear, your emotions, and it helps you to save and invest in a disciplined manner. Lastly, top up your investments if you have idle funds and unwavering holding power. Opportunities like this rarely come by. As I have shared earlier, on average, there are only 3 market corrections in a year. So you only have 3 chances each year. I would lastly like to share what is coming up soon at AutoWealth. In November to December period, we will be carrying out the full launch of AutoWealth Plus. Alongside this full launch, we will be introducing our 5th AutoWealth Plus portfolio, which is named The Future of New Economies. If you not already know it, we have recently launched our mobile app, which is available on iOS and Android. This mobile app is not just a replication of our web application. It includes significant improvements, like, for example, the biometric authentication. Users who are using the user ID and password who do not have a SingPass, today with your mobile biometric, you have higher security. It also features faster loading speed, a new funding notification module where today you can notify us when you make a regular investment top-up with the frequency of daily and weekly. So these are newly added in. It also features the indication of the start date and the end date for the regular investment top-ups. Quite a number of new improvements. Now I've come to the end of our webinar today. I will now move on to the next segment, which is the exciting Ask Me Anything. Okay, so let me first start off with the first question today, posted almost 5 minutes just after we start the webinar. From Joel Lim, he says, "Hi there. I've been dollar cost averaging weekly, a 4-figure sum. Would this frequency or amount be recommended to continue? Or is it better to change to a monthly or bi-monthly regular investment top-ups?" So let me first share with everyone, the regular investment top-ups, right? The faster the frequency is, the higher the chances that you can catch a pullback from the equity markets. By pullback, I mean a decline that is less than 5%. A decline that is 5% to 20%, usually we define it as a market correction. Regardless of whether this is a pullback or a market correction, if you imagined doing a top-up weekly, there is a very good chance you can catch the pullback at the discount and then benefit when the recovery happens. If you do it on a monthly basis, let's say that the pullback happened on the 5th of the month, but unfortunately, your monthly DCA is set up on the last day of the month. Then, if the pullback subsequently recovers by mid-month, you miss that opportunity. This is why we will usually recommend you to commit to a faster frequency if that is possible? The second question by Kong Guang Yi. Among the bonds ETFs used by AutoWealth, what are the typical maturity? 5 to 10 years or 20 to 30 years? With interest rates expected to rise, what will be the impact on the bond ETFs and how sensitive are they to interest rate changes? This is a very technical question. In the professional investment management world, we have this important portfolio characteristics for bonds called the duration. So by and large, you can see duration to be something very close to maturity. If you have a duration or maturity that is very far ahead, let's say 10 years, what this means is that the bonds will only mature in 10 years' time. And whatever currently are the bond holdings, the yields that are featured in the current bond holdings are based on the existing prevailing interest rate environment. Let's say today in a near zero interest rate environment. So you can expect that the bond yields will not be very fantastic. It could be maybe in the range of 3%. Now, what happens when global policymakers, central bankers, starts increasing interest rates? Bond yields would have to increase. And when that happened, the existing pool of bonds versus the new pool of bonds, which one would you buy? As an investor, quite obviously, you will prefer the new pool with a higher yield. Therefore, you may see some existing bondholders that are holding the old bonds shifting to the new bonds, causing the price of the old bonds to go down. Therefore, when interest rates rise, the existing bonds will get somewhat adversely affected. Now, the maturity or the duration is an important consideration. Just now, I've illustrated a 10-year bond. Now, if you imagine that the maturity now is 1 year, what this means is that in 1 year's time, the existing fund's bond holdings would mature and the fund will gradually start buying new bonds at the higher yield when the interest rate environment is more conducive. So there is somewhat a transition process. With a shorter duration or maturity period, the bond ETF will be less affected because they will start this transition quite gradually and quite quickly because the maturity is short. For a longer maturity, the transition can only take place very much later, and this will affect the overall bond ETF prices. That begets Guang Yi's question, is the maturity 5 to 10 years or 20 to 30 years? The bonds ETF that we use generally ranges from anywhere 7 to 10 years maturity. This is not one size fits all. Across the entire bond ETF, there will be some bonds that mature in 1 year time, some maturing in 2 years, 3 years, 4 years, 5 years, so on and so forth. If you take the weighted average, it is probably about 6 years, I would say. In 1 year time, the bonds that mature in 1 year will be repaid, and then the bond fund manager will then use this money to buy new bonds, which will be based on the new and expected to be higher yields. So this transition will take place gradually. We currently do not expect a lot of impact from our current bond holdings. As I've shared earlier, one of the slides when I went through the government bonds, I've shared that largely the expectation of this interest rate increase have been priced in. While the impact has already been somewhat felt, to a certain degree, there's not much of a decline. It is quite measurable. We do not expect a significant decline moving forward. There's a follow-up question. So it says, will the bond ETF allocation or choice of ETF be tweaked to recalibrate the risk? As I've mentioned earlier, our current selection of bond ETFs, we feel quite comfortable because there will be this gradual transition. So we do not expect to experience significant declines in the bond ETFs. Next question by Wei Ling. Capitalization of US debt ceiling should happen by top up now, or would you send a call out when it's opportune? I think quite obviously, Wei Ling has not been on our Telegram community yet, because if you have already been in our Telegram community, which is exclusive for our AutoWealth users, you would have already received our notification where we have shared last week. It is already a good time to top up your investment accounts. Right now, the market discount is about 4% from the recent peak. It has somewhat rebound back from almost close to 6% discount earlier on. Next question, is now still a good time to do ad hoc top up? If you have missed the boat, what happens now? As I shared, the discount is roughly about 4%. If you are topping up, I think this is still a relatively good time. Next question by Chen Chong. Wanted to ask if a portfolio rebalance can happen with the current and existing holdings if there are no cash top-ups. Yes. When you invest through AutoWealth, every single day, our computer systems will analyze your portfolio sometime around 5 p.m. after our cutoff time. We will run the computer systems. We will analyze every single client's every single portfolio. And in this analysis, we will look at how much of portfolio drift or deviation each of the portfolio asset classes have moved. Take, for example, the recent market correction. You would imagine that stocks have declined in value, whereas bonds kind of held quite steady in value. If the deviation of the stocks is larger than 3%, we will then do a portfolio rebalance. This is independent of any cash top-up. So whether you top up or don't top up, if it reaches that 3% deviation, we will automatically rebalance your portfolio. And how do we do this rebalancing? We will be rebalancing it back to the original target weights. Next question. Any plans for a tiered management fees in future? If you have been with us for some time, I believe I have shared our management philosophy before, in fact, a number of times, but maybe this question was from somebody who is not yet our existing user or is a recent user. When we started AutoWealth, our goal was to make investing intelligent for everybody. Whether you are someone who is in a high-flying job, earning big bucks, or you are someone who is working odd jobs, between jobs, maybe not earning that much, everyone, we treat them equally. Every single financial goal is precious to us. Whether is this a goal to upgrade from a condominium to a bungalow, or is this to most people very simple goal to upgrade from a rental flat to buy a 3-room flat. Every single goal is precious to us. And we want to make sure that we treat everybody quite fairly. We do not want to have a tier system which favors somebody who invests larger amount and penalize somebody who invests a smaller amount. I don't think this is our philosophy. So unfortunately, we have no plans for tiered management fees in the future. But that being said, I will share that we have different fee structures for different product offerings. So take, for example, our AutoWealth Starter offering. This is 0.5% per annum on the assets that we manage and a flat platform fee of USD $18. Now we have this new offering called AutoWealth Plus. For AutoWealth Plus, it is unique because we know that this is a high-risk, high-return offering. We want to try something innovative. We want to illustrate to everyone that we are on the same boat, which is why our fee structure for AutoWealth Plus is a 8% performance fee only on the profits that you make. If throughout the calendar year, your portfolio is not profitable, we do not charge any fees at all. In fact, we have to pay for the brokerage commissions and the exchange clearing fees and custody fees. So it illustrates to you our desire to be on the same boat with you when this is a high risk, high return offering. So we have different fee structure for different offerings. We do not discriminate across whether you have a higher AUM or not. I also received another question, which is about China markets. In fact, we receive these questions quite frequently in the recent few months. What is the current outlook on China? I have prepared some extra slides for that. This is what's happening in the macro backdrop in China. There's this whole new environment where policymakers focus on this one term called common prosperity. What does common prosperity actually means? It basically means the central government wants to reduce the wide income gap through a wealth redistribution. In this slide, you will see the chart on the left showing the MSCI China index. You will notice that the recent few months have been circled up. That recent few months have been quite a significant decline. If you look at the actual scale, it is probably close to a 20% decline. 20% decline is no joke. There must be an important reason for such a drastic decline. So what's happening at the backdrop is that there are quite a number of new regulations introduced to clamp down on monopolistic behaviors. What do I mean by that? If you're running a small business in China, you would realize that more often than not, you are being forced to go onto one platform or the other. You are being forced to take sides, whether is this a Alipay or is this a WeChat Pay. If you are e-commerce, you get crowded out by these big players. If you are not on board the big players platform, you'll notice that a lot of supply chains service providers, they don't like to do business with you. There are such monopolistic behavior around that makes small businesses very difficult. Even in the unlikely case where from small you manage to grow it big, the big players will come to you with a very huge offer to buy you out so that they maintain that kind of defendable monopolistic environment. So that's in a way good for the large giants, but not so good for small businesses. What the central government is doing is to allow people to take on entrepreneurship, people who have the aspiration to move up the economic ladder to have the means to do so. So the government broke down these walls, introduced a lot of new regulations, and this affected the large conglomerates. Because of these new regulations, people are uncertain. Will there be more new regulations? How will it impact us? That resulted in a temporary but broad sell-off of Chinese stocks. But that being said, what is important is that, first of all, you need to take a very macroeconomic view towards investments. If you start to panic, you are probably constructing your portfolio wrongly. What do I mean by this? In our AutoWealth portfolios, actually there is some allocation to Chinese stocks because we all know China today is the second largest economy. Its investment markets are, though not as big, but are still material. We do have some positions in China, but you'll notice that our portfolios do not suffer that kind of 20% catastrophic decline. If you are panicking because you suffer a catastrophic decline, it simply means that the way you construct your portfolio has too much and excessive focus on a single market. In today's context, China. The lesson that you should learn is to have more diversification. That's the first point I'll make. Now, the second point is that China remains an attractive economy and an attractive investment market. A lot of leading technologies, for example, payment systems, electric car companies, and many other industries, China remains the leading technology player. This is a market that we all can't afford to ignore. And what this means is that the Chinese market continues to hold a lot of investment potential for patient investors who can take a long-term view. This is precisely the time where you want to accumulate Chinese positions at a discount. When markets are already 20% off the last peak, this is quite a discount for gradual accumulation. Okay, I'm not asking you to put in all your money right after this webinar, but to do so gradually. Try to do it over 1 year period. Why 1 year? Because if you notice what's happening at the policy backdrop, President Xi Jinping will likely or almost certainly be reappointed as the president for another new 5-year term. You will notice that this whole common prosperity seems to be a very nice narrative for him to win that third term, which is the first time in a very long history of China. He's the one and only leader for many decades to break through that 2 times 5-year term time norm. This narrative will likely to continue for some time until he gets reappointed his third term. What we will say is expect more policies to be instituted, more uncertainty, but alongside this uncertainty and market discount that presents itself, this is a time where you want to gradually accumulate positions. Next question by Chen Chong. Will you comment on the non-farm payrolls and unemployment numbers coming out at 8:30 p.m., almost about now? The employment numbers, according to forecasts, is likely to be very positive. Positive enough for the Federal Reserve to move ahead with their plan to taper the asset purchases. Chairman Powell already shared that he's looking for a decent report. He's not looking for a very, very strong report. He just needs a decent one for him to move ahead with that asset purchase tapering. I would think that we shouldn't have much surprises. It should satisfy that decent definition. I think that's the most important thing. It gives us that certainty or near certainty that for the November FOMC meeting, the Federal Reserve will proceed to do asset purchase tapering. I will also further add that what's more important is that these asset purchases tapering is done with a precondition. That precondition is that economic recovery and reopening is well in progress, that we are on solid footing for this recovery to continue on. The policymakers are not going to stifle this progress. I don't think we should see this as a negative. We should see these asset purchases tapering as a positive signal that the economy is on solid footing. I think what's more important as a fundamental is also to look at the corporate earnings release that will happen starting next week with the banks announcing their earnings. I think that's about the end of our webinar. I'll thank everyone for tuning in. I will look forward to the next webinar. We are pegging this to major developments, whether developments that has already happened or a major development that is about to happen. For example, at this webinar, we share with you there might be some nervous going into the market when we come close to the November FOMC meeting. Markets may also be nervous when we come close to the 3rd December end date for the debt ceiling. We are proactively telling you what's going to happen and proactively sharing with you how you can react to it in a rational and intelligent way so that you can improve your investment returns. We will continue to do that for our future webinars. Whenever we see major developments that's about to happen, we will always try to proactively preempt you and also share with you what you should do. I will thank everyone for joining me today. We hope to see you at the next webinar. Have a great evening. Goodbye.